Hi, I'm Jason Mandenack, and I'm joined here today by Dan Hyman and Alfred Murata, co-managers on the PIMCO Mortgage Opportunity Strategy. Dan and Alfred, a lot of investment managers utilize the mortgage market in many different ways. Some of the more well-known mortgage strategies really seek to outperform the Barclays aggregate index over long periods of time. You seem to access the mortgage market in a much more benchmark agnostic way. Can you talk a little bit about your approach and what makes this strategy different?
Well, to your point, many managers do utilize government guaranteed mortgages as a way to outperform the traditional Barclays Ag, and it makes sense. When you look back at the risk-adjusted returns, government guaranteed mortgages stands out. And so you've got high risk-adjusted returns, low correlation to equities, a great place to be if you're a fixed income investor. Now, within the mortgage opportunity strategy, we are not tethered to a benchmark. And so we more tactically move around where the best opportunities are. So obviously, the non-agency mortgage market has provided tremendous opportunities since the financial crisis as things fell in price.
We think that there's many opportunities outside of the securities that are in the Barclays aggregate index. The reason for that is that many investors are just not going to buy these assets if they're not in the index. But one area that investors are not participating is in securities that don't have investment-grade ratings. In the non-agency mortgage-backed security space, 93% of the bonds that used to be AAA rated are no longer investment-grade rated. And that provides opportunities for investors that have the flexibility to invest in such securities and can perform due diligence on their own rather than relying on the rating agencies to analyze these securities.
The PIMCO Mortgage Opportunity Strategy was built with a great deal of flexibility. How do you think about managing risk to help the strategy navigate changing interest rate and credit spread environments?
I think when building the portfolio, it's important to think about two things. The first is do you like the asset on a standalone basis? And the second is, how does it fit with the overall risk within the portfolio? The goal is not to get the trade right. The goal is to build a diversified portfolio across a variety of economic scenarios, not take a singular concentrated bet. We want the portfolio to do well if interest rates rise. We want the portfolio to do well if the Fed does not raise interest rates. We want the portfolio to do well across a variety of economic scenarios, and that requires diversity.
Risk management is extremely important at PIMCO and also with respect to the mortgage opportunity strategy. And one way that we implement this is through various stress tests, looking at different economic scenarios, looking at different rate scenarios, looking at different credit scenarios. We want to be sure that the portfolio will perform well in a wide variety of different scenarios rather than just focusing on yields in one particular scenario.
Dan and Alfred, we've covered a lot of ground today, but in thinking about the PIMCO Mortgage Opportunity Strategy, what would you say are the three key takeaways from today's discussion?
I think the first is that it's a flexible strategy providing us the opportunity for high-quality risk-adjusted returns away from your traditional high-yield or core bond betas. The second is we have a lot of levers to pull. It's a very flexible strategy. We have government guaranteed versus non-government guaranteed securities, US versus European, commercial versus residential. It's a broad, very flexible strategy.
And third, at PIMCO, we have the resources around the world to find these best ideas within a global mortgage opportunity set and include those in the strategy.
Thank you very much for your time. Really appreciate it, guys.